some of the brightest minds in the industry on a panel that we've had now many years running, and it's on the industry investment outlook. And we couldn't be in a more dynamic time to have this panel with all the, I'd say, ups and downs in the market, but it's really not ups and downs. It's really been just an incredible year of downward trends in the biotech market. Everybody predicting massive merger and acquisition. So it's a great time to have this panel. And we have a fantastic moderator in Jennifer Fox, who's a newcomer to the USAIC family. So Jennifer, we hope that you, A, do a great job, and B, that you enjoy the job that you're doing so that you'll want to come back in the future. For those of you who don't know Jennifer, Jennifer has spent the vast majority of her career as an investment banker. Her last role prior to moving into biotech was at Citigroup, where she led the healthcare for North America. And then in 2020, Jennifer jumped into biotech, and she's now a chief financial officer at Nuvation. So Jennifer, good luck with these panelists.
Thank you. Thank you, Andy. Thanks for the invitation. I'm delighted to be here for the first time and amongst so many of the most distinguished folks in the space to talk really about the industry and trends and investing ideas. And most importantly, I would have re-entitled the panel to say, oh boy, what a difference a year makes, right? So I think we should just start off by having the panelists briefly introduce themselves, name, where you are, anything else you'd like to tell us. And then let's move into so many of the topics that people are anxious to hear from you on. So Chris, why don't you start us?
Well, thank you. Good to be with you all. Chris Viehbacher. I'm a founding partner of Gurnet Point Capital, former CEO of Sanofi, and I was also heavily involved with the COVAX initiative for vaccines these past 2 years.
Thank you. Hari.
I'm co-founder of Jubilant Pharmova, which is a pharmaceutical company based out of US. We also have a company by the name of Jubilant Therapeutics, which does work around cancer therapeutics. We also have a company called Biosys, which does drug discovery.
Thank you. Stelios.
Stelios Papadopoulos. If you go way back, formerly an academic scientist, formerly a biotech analyst, formerly an investment banker. I'm currently the chairman of 3 separate companies, Regulus Therapeutics, Exelixis, and Biogen.
And Rajiv.
Yeah, hi, I'm Rajiv Kaul. I manage the biotech fund at Fidelity. Fidelity is probably among the largest investors in biotech. And I've been investing in the space for about over 2 decades. Thank you.
Well, thank you all. I think we should just jump right in because there's so many topics. There's so many topics we won't even be able to cover in the short time. I would just tell folks in the audience that if you were here last year, the topics from last year are still incredibly relevant, but the environment has changed so dramatically since then that both opinions and views on the long-term impacts of this particular market may have changed. So I think it's incredibly interesting to explore at the outset Rajiv's foreshadowing of a challenging market. And so Rajiv, love to hear from you what things you were looking at early on to indicate that the market might be challenged going forward, and how you might weigh your expectations a year ago to where we are today. I mean, if you look at the stats, we all know them well, right? 71% decline in terms of enterprise value of the companies, 80+ decline in terms of new issuances. A big M&A deal hasn't been accomplished since 2020. All the things that are indicators that our industry is struggling. So just would love to hear from you. How did you foreshadow that? And based on your expectations last year, what do you feel about today's market?
Well, you make me sound smarter than I am, I think. It just felt last year there was a binge situation. A lot of companies were getting financed, very early stage companies, very easily at high valuations. euphoria around the success of the mRNA vaccines and the impact the industry had on COVID, led to a period of excess financing. And that was the simple view at the time. And, if you look at the last several decades in biotech, the industry does go through these periods of boom and bust. Low interest rates and the macro environment certainly fueled the low cost of capital and a risk-taking environment. It felt inevitable that would lead to a correction. Anytime you have these excesses based on promise and not data, it leads to reduction in valuations, clinical setbacks, and a period of correction. In this case, probably one of the most severe corrections we've had ever. So that was the thought then. Well, today, when I think about my outlook for the next, year, 3 years, 12 to 18 months, I'm quite optimistic that valuations now are in a range that are more attractive than we've seen in 20 years. In fact, on an EV to cash basis, the industry is trading below where it was during the end of the dot-com crash in 2003. Probably the cheapest we've seen in the last 20 years. There's 25% of the industry is trading below cash. And I understand that this is a very capital intensive industry, and that, cash has limited value in a biotech company since they're very reliant on raising money, and the cost of capital has gone up significantly. So it's hard to pin a value on the cash, but it's quite extreme from a historical valuation perspective. And you can't forget that the fundamentals of the industry continue to remain very promising. This is a great moment in science and translation. The need for innovation in biotech is immense. We've seen some early activity from the pharmaceutical companies with recent acquisition of Biohaven for $11.5 billion. Arena got bought out, Turning Point got bought out. If you look at the balance sheets of the big pharma companies, they're extremely well capitalized, and there's some serious drugs going off patent between 25 and 30. And that's not going to come from internal innovation in the pharma industry. That's going to come from these 500 public biotech companies, and I think another 500 private biotech companies. So I'm quite optimistic that this is a moment when stock picking and real fundamental due diligence and a long-term investment outlook can really make a difference for our shareholders, especially if you're able to have access to capital. And a lot of the players in the industry that were sort of playing the boom, many of them have gone away. So that for those that are surviving, that's, I guess, a positive environment. It's a buyer's market. So I'm quite optimistic. When I look out, we're going to need more fundamental data to come through in the clinic. My preference is generally for companies that are, have data or more advanced in their development process and that are well financed with real breakthrough type medicines. There's plenty of those ideas. But there's also going to be a lot of companies that are early and still need to raise a lot of cash and really are conceptual with very little basis in clinical data. They are going to continue to probably have a difficult time. So you might see this bifurcation. But overall, I feel like I have a lot of good ideas, and I'm willing to be patient, and I'm willing to stand with the best management teams and support the companies that we've invested in and take a long-term view. So I hope that's a helpful view for me.
I think that's incredibly helpful, and it touches on so many of the themes that people care about right now. So maybe moving to our resident historian / librarian, and I literally say librarian because I know that in his basement somewhere, he has every single IPO prospectus that has ever occurred in our space. But Stelios, I'd love to hear from you on two topics, one of which is just generally the IPO market, since you've tracked it so diligently over the years, and what is different in terms of the profile of companies that need to get out over the next 3 to 5 years, given today's environment. We obviously robustly funded a number of companies at very early stages. Does it change the dynamic of the profile of a company that wants to get public? Do VCs get impacted in terms of the size of Series A, B, and C that occurs before. Just love to hear, first of all, your historical perspective of pullbacks in the market for IPOs, and then what you think this foretells for the future.
Sure. The most important point is it is valuable to look at history, keeping in mind always that it repeats itself in rough terms, but not in precise terms. So we cannot assume whatever happened in the past will happen exactly the same way today, but certain fundamental forces are always in place. The two in the history of biotech IPOs, starting way back in 1979, with the first legitimate recorded IPO, there are two particular times, other than the most recent time, where the IPOs just went haywire. One was the 1991-1992 period. The other was the 2000, late 1999 and all of 2000 period. And maybe I'll focus on that one because that looks a lot like what we've been through today. Back, believe it, until about 2 years ago, the records set, a number of records set in 2000 were still intact. And it was only in 2020, 2021, we started breaking those records. So that, imagine 20 years ago, scale being quite different every which way, to set records that lasted 20 years must have been, in quotation marks, a crazy market or an irresponsible market. And it was. And in fact, very much like what is going on now, that valuations are being reset, companies are shrinking, going out of business, doing, quick reverse mergers, all that happened in the aftermath. By the end of 2002, roughly 90% of the IPOs of 2000 were trading below the IPO price, not unlike what we're seeing right now. The usual thing, trading below cash, which, by the way, it's a metric nobody should ever consider because the cash in the bank of a development stage biotech company is an illusion. It's there, but you cannot touch it because unless you go in, throw the board off, fire the CEO, terminate the programs, and salvage whatever cash there is, it's almost mathematically certain the company will spend that money. So the only thing to look at is whether, in fact, their programs are valuable and likely to reward the investment or not. So cash in the bank, totally irrelevant. The real consideration is that is a good, useful lesson from the past. Once the market completely went away, very much like the way it is right now, getting an IPO done is sparse. Although I would argue if somebody would set their expectation and valuation, there is smart money around, far more smart money around today than it was 20 years ago. So if somebody want to do an IPO of a company that a year ago would have tried to go out at $1 billion, they want to do this at 200, they'll get it done. They'll take a while to reset. But back to the lesson from the 2000 era. By the time IPO started coming back timidly, which was October 2003, and went on for a few years here and there, the companies that went public were no longer the aspirational, all-powerful technology, solve the problems of the world companies. They were a lot more limited, data-driven. Data may have been unexciting, but at least some data, maybe a repurposed drug, maybe a new formulation or something. So, and I suspect that is likely to happen again. Rajiv mentioned before he'd like to see data rather than ideas and plans and vision. And a little bit of a worrisome thing is right now, if you look at where a lot of the venture money is going into, a lot of it's still going into platforms. And I suspect a platform that is 2, 3, 4 years away from legitimate clinical trials may not be attractive to IPO investors in the next 2, 3, 4 years. And by the way, let's be careful about the markets. We need to have, clearly a near-term focus, but a long-term view. A week ago today, the 5 of us were on the panel talking about the markets. Between then and now, in a week's time, most biotech stocks are up 10 to 20%. So you'd say, well, maybe it's over. Maybe this correction is done. Maybe we're on the upswing again. We're going to talk some more about the markets and what this last week has meant. But again, the fundamental point is, I think the market, and I'm not sure I will be excited about this because I do like technology platforms. I do like innovation, but I suspect the market will start looking more at clinical trial data, more precise, manageable, understandable, quantifiable types of companies. And I'll stop.
I think those are all great points, and I would just pick up on a couple of them. The first is that a lot of companies that went public were very early stage. And when you think about what's happened in terms of value creation for those companies, it's not there, right? And so as people think about funding them into the next stage of development, where just this year alone, you need greater than 10 billion to fund development stage companies that are already public. It's a big challenge, right? So do we need phase one data, which isn't moving the market, to be a predecessor of being a public company? I don't know the answer to that, but we have a ton of publicly traded companies with very little near-term catalysts that seem to be driving the market. I would say in addition to that, we have an M&A market that's starting to percolate a little bit. And Chris, I want to thank you very much for announcing something this morning, which is differentiated and interesting, I think, to all of us in a bunch of different contexts, right? A public company that's been trading for a very long time, diverse set of programs. We don't often hear about companies being taken private in our space. And I think we've heard about a lot of different, more creative things that could happen in our space, whether it's bankruptcies, returning cash to investors, et cetera. So we love to hear from you a little bit about the trend in M&A, and in particular, this take private of Radius, which has been a long-term existing company on our publicly traded markets.
Well, thanks, Jennifer. I mean, I'd just say, what's happened in a year first is that if you look at how much money got invested in the biotech sector over the last 2 years, it dwarfs any other period in absolute amounts. And if you look at the number of IPOs, et cetera. And, I think part of the problem is that you can dramatically increase the amount of investment capital available, but the amount of investable opportunities doesn't necessarily rise in the same proportion. And, I think one of the problems we have is we have a lot of companies that got funded and a lot of people got promoted into some pretty nice roles that really wouldn't have passed muster in the past. And so, I think that's where Rajiv was going. This is where stock pickers will have to go through and start looking for companies much more on their fundamentals. And I think from a public point of view, I think there has to be, again, a discussion around who should be public, because who went public over the last couple of years was pretty much everybody that could get their audits done and all the other requirements to go public. And I think some companies went public way too early and shouldn't have been public. For Gurnet point, I mean, our investment thesis has always been we're operators and not investment professionals. So we look for companies who are in some difficulty, and we bring our collective professional backgrounds, experience, and networks to help those companies actually do better. And so we become kind of specialists in looking at companies who are unloved out there in the marketplace. And a lot of those companies have nowhere to go. They either can't raise more capital or they've got capital, but their share price is depressed. And sometimes going private is a good way of resolving the situation. We acquired a company called Corium, and we saved it from basically a further stock price degradation. When they got a CRL from the FDA. You can go and fix things in private, and then you can take them back to the market once they're fixed and everything is growing again. We did that with Kaul, and Radius is another case in point. It's got a nice product out there in the market, selling almost $300 million a year, but had a market cap of less than 500 million. And that is a company whose pipeline wasn't really delivering. And so this is an opportunity to take that company private, re-engineer it, perhaps add some more products, and then come back to the marketplace. Problem is there's like 800 public biotechs. And so M&A is not going to solve the problems of all 800, or even maybe the 200 that are really in difficulty. So I do think that there is a clean out to be done in some sectors of our industry. And I think some thought process about who should really be public. Because if you think about it, this should be a sector that does well right now. This isn't a sector that really gets worried about inflation or all the global crises. We're supposed to be the non-cyclical place you put your money when everything else is melting down. And I think the reason it is not is that, you know, we have seen an awful lot of disappointing clinical and regulatory results that are a function of probably companies going public that perhaps shouldn't have been in the first place.
If Jen,
Yes,
if I
I
could
think
just
that's-
add one
please.
word to this point that Chris made, just quickly. We keep on talking about the market as if it's punishing us for whatever reason, and that the baseline, the fair valuation environment was 2020, 2021. What I've been saying is that finally the market has become sensible. These valuations are sensible valuations. The other ones were just crazy. And the market is not being bad or vindictive. They're now just being reasonable and sensible. Sorry.
So respectful of that comment, whose fault is it? To be a little controversial, like whose fault is it that all of these early stage companies have been funded in series A, B, C to an extent where the expectation from public market investors was that they would get a return on day one that was completely divorced from, you know, what I was taught 25 years ago in terms of expected returns for IPOs in the near term. And so I think it's really interesting to take a perspective after the fact, after we funded hundreds of companies that are preclinical in phase one on our hopes and dreams at really high valuations. But I'd love to hear a little bit from the panel on, you know, whose fault is it? I think we got super excited about innovation. We expected returns in a market that was robust, but we forgot about the reality of clinical development in a way. So I throw that out there to the team. And then, Harry, I'd love to hear from you as a follow-up. In terms of your expertise on innovation and technologies coming out of India and other countries specifically, how can you help us bridge the gap from research, early research, and a really innovative economy to where we might need to get to for US, European, and other countries' IPOs? So start with, you know, whose fault is it, everybody? And then, Hari, love to hear your perspective on innovation.
Well, I'll just quickly chime in on this. Look, very briefly, it's always the same. It always starts with excess liquidity. There's too much looking to invest in particular types of securities. If a particular sector, for reasons, we can go into the reasons how the pandemic and, you know, cyclicals and all that. Once a particular sector shows above average returns, more money comes in. You cannot be a fund manager sitting in the sidelines getting benchmarked against people who buy these IPOs and record 30, 40, 50% gains. So you got to get in. So excess liquidity begets increased liquidity. And this keeps on going because by then, most people that are buying the stocks have no idea what they're buying, other than the last go around, the stocks went up. Not unlike the housing crisis in Florida, or all sorts of other bubble type situations we go through in the markets. And then at some point it corrects itself, and it's always a little different what brings about the correction. But it's the excess liquidity. Now, investment bankers are servants to capital availability. If the market wants aspirational technology platforms, whatever it is, they'll package them. The VCs will manufacture them. The CEOs will go there, run them. So it's always about where's the money and for what reason there's a beginning of above average returns, and then people just crowd there. I don't know. Rajiv probably lives to this all the time. You should have a view on this.
Well, I agree with you, Stelios. I mean, I think it's this confluence of institutional incentives and human psychology and excessively low interest rates in a moment in time when, you know, you go through these moments when it's the science is going to rule the world, and you when all these things come together, I think the fact that the biotech industry played such an important role in the pandemic and the success that came from mRNA vaccines was definitely a sentiment booster in the sense that, wow, this industry is coming to age now, and there's going to be all these great breakthroughs in all these other diseases. And, if you do well in investing in biotech, you can make 10 times or 20 times and 50 times and 100 times returns. And tech people, with all their exuberance around how the tech companies also sort of flourished during COVID, make this leap of faith that, oh, well, it's all software anyway in cells, and it's all hardware. If we can engineer, silicon, we can engineer carbon. And, it's just the genetic code. It's just nature's software code. And, and while that's all true, there's a risk and an execution process and an FDA and, and a whole level of discovery and an unknownness in human biology that's not comparable to silicon-based technology, at least this moment in human history. But if you have a lot of money and you're willing to, look far into the future, you can make up these sort of stories about how everything's just going to be so amazing. And if you're a venture capital institution, you've got a lot of companies in your portfolio. Maybe 2 years ago, you were not sure if they could get funded. Now they're all going to get funded, so you're going to push them all out. Your point about the bankers is well taken. So I think this is, it's tulips, and so it's just biotech tulips. And it happens all the time in the biotech industry. And I think there's a fundamental quality why I think this industry is so prone to boom and bust, is because I think it has such a fundamental importance to all of us. Nobody wants to have a horrible disease, and we want to cure cancer and Alzheimer's disease. So it's going to come from these companies. So it's very easy to create a lot of hope, and people buy into that. But it's inevitably followed by disappointment because it's just so difficult and unknown. But at the same time, longer term, there's real progress being made, and you learn from the disappointments, and you go back and try again, and then you get big breakthrough drugs like we've seen in the last few years. We just talked about the mRNA vaccines, for example, and so many great examples of progress in the industry too. So I think it's a function of all these dynamics.
Yeah, appreciate those comments. And Hari, love to hear from you because India has such an innovative economy. We'd just love to hear how you all are advancing science and how you could supplement some of the efforts that are going on worldwide.
So Jennifer, as you probably know, the India story on drug discovery really started almost 20 years back. It started as more as a service industry on medicinal chemistry side. And then slowly India built a lot of capability around biology. And the interesting part is, a lot of Indian diaspora is part of US pharmaceutical industry. And a lot of them came back. And, companies like ours, we hired people from US, from very large companies who were so very well trained in modern science and in good science. So, and then from service, it started to be risk-taking. So I think today I can see almost 20-25 large companies and many small biotechs doing work around early stage drug discovery. And some of the companies that you hear about being sold for multi-$100 million, almost entire early stage work has been done in India. And even my own company has done for many, almost more than 100 early stage programs, some of them for biotechs, which have been sold at a very high valuations. And even companies like ours have now our own proprietary drug discovery programs, which are, and of course, we were quite excited in the last 2 years when the early stage companies got very good valuations. And instead of licensing, companies in India also thought they should go and list in US. But I think that we'll have to wait for a new a new opportunity on that. So more and more, I think the Indian companies would develop early stage programs and partner or license to to either large biotechs or pharma companies. But I can tell you, if I look at what happened in the tech industry, today we have almost 15 to 20 unicorns every year in the tech industry. And I see a similar thing happening in the next 5 years. We have a lot of startups on AI ML base, so using technology to accelerate drug discovery, a lot of investment. There are 3 clusters actually, if you see Bangalore, Pune and Hyderabad, where you have institutes providing good manpower, enough funding coming in from either industry or venture capital, and government supporting many of the early stage startups with large amount of funding. So I see interesting science coming out of India, starting with small molecules mostly, and then hopefully more and more on the large molecule. The vaccine part helped us a lot because during the last 2 years, India developed many vaccines and a lot of clinical trials got done. So I think to that extent, the Indian public is starting to support clinical trials. There is a mindset now that for drugs to be developed either for the world or even for the Indian market, more and more trials should be done in India. And I think the regulatory framework is starting to open up. And I hope that in future we'll have faster approvals for clinical trials also. So I think it's an interesting period for India. We are learning from what is happening in US very effectively, because Indian companies are either invested in US or well connected to what's happening in the ecosystem there. So I'll stop here. I do see, in spite of the slowdown that I see in US, India will continue to support because it's a low cost economy. So even the cost of doing early stage research is 1/4 of what probably you do it in US. So I see more and more programs being done or outsourced in India, and that will only enhance the capability here. Thank you.
Thank you so much. And I agree, it's an incredible resource for companies around the world to tap in terms of innovation, low-cost strategies, incredible medicinal chemistry, incredible research and innovation. So we really appreciate your perspective on that. We're going to go quickly to some questions from the audience, but I'd love to leave 5 minutes at the end, because I think everybody who's on, and I hope there are many that were on last year and that are on this year, would just love to hear how this entire panel is advising companies on what they should be doing in this market. We've seen a lot of prioritization of programs, headcount cutting, all of those sort of things, but we'd love to hear from this panel of veterans, and I mean that in the kindest way, including myself, what we all should be thinking about in terms of long-term for our industry and what you all are advising your own companies and your boards and investment opportunities to give. So before we do that, let's go quickly to questions. Thank you so much for so many questions from the audience, but I'd like to go to Christina Trudell from Hanson Arch from Arch, and we'll start with her question, and then we'll move on to a couple more. So thank you so much, Christina, for joining.
Absolutely. Thank you for a fantastic panel here, and great job, Jennifer, on the moderating the gentlemen here. Really interesting panel here. So one of the things that I'm, you can say, working on both as an entrepreneur and with one, you can say, foot in the VC world is curious to hear with the macro environment that's here, what are the advice that the panel would give to either people that's on the road fundraising or management teams that has just maybe closed a Series A round or B round?
Perfect. You just saved a wrap up, so we gained a few minutes. So let's hear from everybody on that. I think that's the most important thing that people want to hear from you all.
Well, I'll start. I think one of the things we have to remember is that we've had a long period of the factors that Stelios and Rajiv laid out: low interest rates and lots of liquidity. And so we have a generation of people in the industry, whether they're running companies or in banks, that have only seen markets really go up. I think it is an important lesson that markets can also go down. And so one of the things I think will be important for everybody is to say, just because I can raise capital doesn't mean I should go spend it right away. And, you know, there has been a long period where if I had good news, I was sure that I could just go to the market and find liquidity like it came out of a tap. So I think there will be, you know, some readjustment that is needed. At the same time, I would say the last time I had the great pleasure of seeing my friend Stelios in person, he gave me this wonderful gift, which was a copy of the IPO for Genzyme. And everybody thinks of Genzyme as being a rare disease company, but as Stelios pointed out, when you looked at the IPO, it wasn't an IPO of a rare disease company. And that just says that actually, you know, what you really want to do is invest in really good people with really good ideas and some good technology. And I think as you go out and raise money, you know, in a lot of ways, it's around you as the entrepreneur, how respectful you're going to be of other people's capital, and, you know, really presenting, your ideas in the most realistic way possible. I have to say that everybody that comes and pitches me something and shows me a $20 billion addressable market, I usually tune out right after that, because I figure that they haven't really even thought about where the patients are that are really going to benefit. But, you know, to me, Genzyme is still a good case, and you know, you look what a great investment that was for everybody, and but people, that was really because of Henry Termeer, and so, you know, you need to really position yourself as I think the entrepreneur that can be successful and is a good steward of people's money and has a passion for finding things for patients.
Let me just add
Thank you.
quickly one point
Yes,
here.
please, Phil.
The argument Chris offered regarding the lack of context for those in the industry today, the younger generation, is hugely important. You don't understand market until you've seen several cycles. It's as simple as that. And the first reaction now to the adverse conditions is to trim down, rationalize, prioritize. These are the words, you know, being discussed in every board. So a typical company that until yesterday was spending, say, 100 million in 4 programs is now deciding to discard the 2 less promising, or 3, keep 1 and trim down to 40, 50 million spent per year. There's another level of sophistication and another level of sensibility, which is to say, even my best program, is it likely to return on investment above my cost of capital, above, on a risk-adjusted basis, what people should be looking for returns in that space? No one is doing that yet. But if you do that, then you realize even your best case, your best program, isn't likely to return, then what you've got to do is rapidly and sensibly shut down the company, give the money back, or do something else with the money rather than just spending it on something that won't work out. And that's not quite happening yet. It's obviously very difficult emotionally for this to take place, but that's what we have to be thinking about. We're throwing money after bad ideas. The early doesn't bother me. There's a price for early. But I can tell you this, a company 3 or 4 years away from the clinic with a $4 billion valuation, unless a crazy pharma comes in to buy them halfway down the line, they will never return on investment. Never. It just can't happen.
I'd add one thing here too. I'd say in this universe of so many biotech companies, there are going to be some real gems. And if you are a CEO or board of a company and you think you've got outstanding data or even outstanding science or a breakthrough potential, but you're capital constrained, or you feel like your stocks are really undervalued, please give me a call. We're open for business because I'm looking for ideas. That's the other part of it too.
And if I can just add, if you are constrained of capital and you are doing early stage research, outsource to Indian companies, that capital will go longer. And there's some great science being done here.
Let me support that. In my capacity as chairman of Exelixis, pretty successful by now after very many years, cancer-focused company. We used to do a lot of work with Indian companies that would be the conventional contract-based chemistry and other activities. Well, as of the last couple of years, we're now doing work with companies that are innovating. They're generating novel compounds. We partner with them, we license them. So that transformation is taking place. May not be very visible to the US capital markets, but it's going on.
Thank you. Thank you, Stelios.
Great. Well, thank you so much, Christina, for the question. Love to go to David Meeker for the next question, please. We only have a few minutes left, so let's try to leave at least a minute for a wrap up, but thanks so much for the great question. David?
Yeah, thanks, Jen. Great panel. So quick question here. I think I heard the panel. Everybody's in agreement that this market needed a correction. Everybody highlighted the fact that it's a boom bust industry. We've been through these cycles before and are in one now. My question, I also heard fundamentals mentioned multiple times. So my question is this a market that trades on fundamentals, or does it trade more on stories? And has it ever really traded on fundamentals? Because if it had, wouldn't that be some insulation against a true boom and bust kind of scenario?
A great question. Thanks, David.
Well, as someone who's been doing this for 4 decades, I can give the historical overview. Look, the one thing that we lacked in the 80s, and I was pretty active in the market in the 1980s, we did not know how big the breadbox would be because we did not have commercially successful companies. By the time we started getting to the 90s with Genentech and Amgen, a couple of others, starting to sell products, we started understanding what was the size of the opportunity. And onward from there, by now we understand extremely well what that opportunity could be. And guess what? Along the way, the size of the attainable, realizable opportunity is getting bigger. I mean, Chris will tell you he made a deal with Regeneron some years ago, a truly transforming deal for Sanofi. And yeah, I guess David were on the other side of that at that point. If you look at Dupilumab, and what it's becoming as a product, I mean, that's not the sort of stuff we had in the 80s or in the 90s. So the size is getting bigger. And that's the problem now is not so much, not realizing that things could be big, but now I'm going to have $100 million niche product or, ultimately a $20 billion product, out of the research. And that's where the valuation gets difficult. Now, with some experience and diligence, you can narrow down the focus a bit, but it's tough. It's still tough.
I'd make a point here again, which I think is relevant. It's one thing to focus on the market. We spent a lot of time talking about it, but it's sort of not that relevant from a fundamental perspective, because what you really care about is your drug and your company. And I really believe that no matter what the inflation rates are, and who knows what's going to happen there, and we all have our theories on it, and we'll see how that plays out. But I'll give you an example. What matters is a breakthrough drug and breakthrough science and great quality companies that are able to manage their capital structures. And if you can do that, you're going to do great. In 2001, Gilead launched Myriad. The stock went from, I think, 4 billion to 45 billion in 3 years. The NASDAQ went from wherever, I think it went from 5,000 to 1,000. The 9/11 happened. The stock market crashed. It was close to 3 days. Greenspan was raising rates like crazy. The rest of the biotech, the genomics companies went out of business and had to restructure. They were down 80, 90%. But Gilead went up tenfold. And that, to me, is the key. And I think that's what we're looking for. I think as CEOs, as investors, boards, management teams, we got to focus on making those breakthrough drugs. And if we can do that, I think the market will take care of itself.
And one thing, Jen, if I could add, just to set the record straight on interest rates forever, there is a certain naive class of investors and analysts who say, rates are going from 2% to 4%. Therefore, we need to adjust our discount rates for expected returns in biotech. But if your expected returns are 20, 30, 40% per annum to reflect the risk, of what you're getting into, whether it's going to be 22% or 21%, it's irrelevant. It makes no difference. The only way rates matter for us is when the big sums of capital shift out of equity markets into the fixed income markets. And along the way, a lot of the money at the margin that invests the generalists in biotech because there's a lot of money is not there anymore, and they don't drive price. but not in terms of the discount rates and expected returns.
And isn't that
Rajiv said.
really, Stelios, isn't that really the answer to David's question? Is that, you know, a lot happens when generalists come in and come out. Right now, we don't have the generalists in. And I think if the market comes back, it's going to be driven by smart people like on the panel, the rest of the panel here. And so you need to be focused on the fundamentals. When the generalists come in, they have not the same appreciation, I think, for the fundamentals. And so the story starts to play. Personally, I think as a CEO, it's always good to focus on the fundamentals. And if there's generalist money around, well, then get a little creative on your storytelling on top of that. But I think you can never go wrong by really focusing on good fundamentals of business. I
have a biomarker. When you ride a taxi with a colleague and you talk about biotech and the taxi driver says, "Oh, what do you think of stocks X, Y, and Z?" Sell the stocks.
Uber driver, Stelios, right?
No.
Hey,
Taxi
they're
drivers. I'm
smarter than
loyal.
many sometimes, you know. Don't judge because they're driving an Uber, right? But yes.
But I agree with these points very, very, very 100%. You know, what Chris is saying about focusing on the fundamentals. And that's what you can do as a CEO. And you can maybe hire better people and you know, trying to use this as an opportunity. How do you come out stronger? And I totally agree with what Stelios is saying too, which is you have these macro tides that, you know, the biotech sector is sort of this illiquid sector full of very specialist type risk and very specialist type of understanding of the fundamentals. And it just gets swept away sometimes in these macro tides, you know, they just sort of, it's just collateral damage. And, you know, maybe we're in a moment like that, and that can turn the other way too. So those are certainly important factors that one needs to plan for and have redundancies. You know, it's generally better to fly with a plane that has two engines versus one engine. In fact, I think the risk is exponentially lower. So you got to think about how much cash you have on your balance sheet, et cetera, and, you know, think like that. But again, if you have breakthrough drugs and you're able, and this is a great moment in science and development, hopefully we'll see more of these in the next 3 to 5 and 10 years. And those companies will be the ones that we'll be talking about.
Thank you, David. Thank you so much for the great question. We actually have been granted a little bit more time, so I wanted to ask Stephanie Lee to ask her question, and we'll wrap up after that.
Thanks, Jennifer, and thank you to all the panelists. I think my question kind of dovetails nicely with the last discussion. I wanted to know, we haven't really touched on inflation that meaningfully in this discussion. I'd love to hear your views on how inflation does affect various segments of our industry.
Well, the inflation part is going to become entwined with drug pricing in general. And that's a very complicated discussion with many other forces. There's obviously, you know, a cost of manufacturing. There are a lot of costs in the industry that get affected by inflation. But really, at the end of the day, we're a very large gross margin and operating margin business that's driven by discovery, uniqueness, and big opportunity. So whether something costs 20 or 21 is not that dramatically different. It's how much can we innovate. On the pricing side, that becomes important, but that's a far more convoluted discussion that's far more political than economic.
The only thing I would add to that is, Stelios is perfectly right. The only thing you'll find is that, you know, Europe in particular has fixed pricing, so you don't really have much opportunity to increase pricing. So that business on the pricing side will suffer a little bit. But as Stelios pointed out with the margins, it's not really a major factor.
I think Stelios' point is very well taken in terms of the political risk in the United States on drug pricing. I mean, that's an existential risk of the industry. But I think the behavior of the industry has been pretty good over the last few years. So I hope that that's a favorable background in the context of I don't think drug price inflation is what's driving the macro concerns. In fact, it's probably much less of an issue than so many other things. So my hope is that Washington won't have a draconian stand against targeting the pharmaceutical industry in the United States. And the second point, related again to what was just said, is that if you look at just on a theoretical finance perspective here, it's risk-adjusted net present value of future cash flows. And what really drives that is the probability of success. If the probability of success is 0, doesn't matter what interest rates are. And if you have a breakthrough drug, again, that 1% incremental 20 or 21% shouldn't matter either. And from a large pharma perspective, it's actually a very favorable time because they really have the lowest cost of capital and they need innovation. So, this is a very exciting period, I think, from a large pharma perspective.
Stephanie,
Because
thanks for
business
the
is
question.
relatively
that could just
great.
lead to so many more discussions, right? The discussion of big pharma and do they actually acquire innovation, or do they stick to what has traditionally been bigger deals, later stage, de-risk? We didn't touch on everything that's happened with the FTC as it relates to the dynamic and the panel that went on a couple of weeks ago. Didn't get the drug pricing really. So I have to say, I'm just so grateful to the panel and to be included among such distinguished folks. I know that everybody really enjoyed your perspective. I'm sure there'll be a lot of follow-up and advice that's sought as a result of this. But thank you so much for participating. And thank you, Andy, for the very nice introduction. And I do indeed hope to be invited back next year. Thanks, everyone.
Thank you, Jen. Wonderful.
Thank you.
Thanks to all of you.
Thank you, Jennifer.
Thank
Thank you, Jennifer. Wonderful job.